Microsoft just fell about 30% from its high, the cheapest it's been since 2023. Wall Street is spooked by one thing. The company is now spending over $100 billion a year on AI. Is that a money pit or the setup of the decade? Our verdict says undervalued. Let's find out why. Welcome back to Wall Street Holic, the place where everyday investors come to decode the market, uncover opportunities, and understand the stocks everyone is talking about before the rest of the crowd catches on. We break down earnings, valuations, options, market trends, and the big stories moving Wall Street. Without the noise, without the confusion, and without the boring textbook talk, straight to the point. This is research and education, not financial advice. But if you want to sharpen your investing mindset, follow the money, and build conviction in a market full of fear and hype, then make sure you are subscribed. Let's get into it. Quick housekeeping first. This is research and education, not personalized financial advice. And full transparency, we actually own Microsoft, shares, a January 2028 call option up 15%, and a cash secured put that's working. We disclose it, so, we've got skin in the game. The stock last closed near $390. Now the thesis. Here's the 60-second read. Today's price, $390. Our base fair value, $540. What we think a share is actually worth. Confidence is medium. Weight the bear, base, and bull cases, and you get an expected value of $543, roughly 39% upside. Why the gap? Earnings keep compounding while the multiple collapsed to its cheapest since 2023. So what is Microsoft? Three engines: Azure Cloud, the Office and Microsoft 365 Productivity Suite, and Windows plus Gaming, with AI now baked into all three. Last quarter, it did $82.9 billion in revenue. The cloud segment grew 30%, and Azure inside it grew 40%. That's the growth engine everything rides on. Why can't rivals just catch up? Distribution and lock-in. Once a company runs on Microsoft 365, Azure, and its identity tools, leaving is painful. That's the moat. AI is already a $37 billion run rate business, up 123%. And its OpenAI stake is effectively a free call option on whoever wins the AI race. Now the numbers that carry the thesis. Trailing revenue, $318 billion, up 16%. Net margin, profit per dollar of sales, sits near 39%, which is elite. But free cash flow, the cash left after running the business, dipped to $73 billion. That's not weakness. It's the AI spending we're about to unpack. And here's the whole debate in one slide. Microsoft is pouring over $100 billion a year into AI capacity. Bulls say that spend is tomorrow's cash flow engine. Capacity is sold before it's even built, backed by a $368 billion order backlog. Bears say it's outrunning returns and crushing margins with no payoff guaranteed. Everything hinges on who's right. The balance sheet is a fortress. One of only 2 US companies rated AAA, about $78 billion in cash, low debt, and over $170 billion in annual operating cash flow. The one shift worth watching: Microsoft has quietly moved from net cash to modest net debt as it leases AI data centers. Notable, not alarming. Is it actually cheap? On earnings, yes, about 21 times forward, well below its own 32 average. The quality test: return on invested capital near 27%, roughly 18 points above its cost of capital. Translation: every dollar it invests creates value. The one ugly number, price to free cash flow, is just that CapEx distortion again. How big is the runway? Cloud migration is still under half of all enterprise workloads, years of Azure growth ahead. And AI attach has barely started, only 20 million Copilot seats against 400 million Office users. As pricing shifts from per seat toward per outcome, that's a long monetization ramp. Now the risks ranked. The big one, that AI spending simply doesn't pay off, keeping cash flow suppressed and the stock cheap. Close behind, depreciation from the build-out eroding margins, already down to 68%. Then regulatory scrutiny of the OpenAI tie-up, fierce cloud competition, and a macro slowdown. Watch Azure growth and margins every quarter. On competitive structure, the picture is clear. Switching costs keep buyer power low, and hyperscale barriers keep new entrants out. The pressure points: intense rivalry from Amazon and Google, and reliance on Nvidia chips. The verdict: a best-in-class disruptor wrapped around a legacy fortress. The debate is the price of admission, not the quality. So what's it worth? A discounted cash flow model, projecting future cash and discounting it back to today, gives about $515, but only if you let cash flow recover as capex peaks. Extrapolate today's depressed number, and you get roughly today's price, which is exactly why it derated. Cross-checked, we anchor base fair value at $540. A second lens agrees. Against other mega-cap tech, Microsoft trades near the bottom of the pack on forward earnings. Despite top-tier returns and mid-teens growth, put a fair multiple on next year's earnings and you land around $545, right in line with the cash flow model. Here, the discount itself is the opportunity. Let's price the outcomes. Bear case, $430 at 25% odds. Base case, $540 at 50%. Bull case, $660 at 25%. Weight them together and you get $543, that 39% upside again. This isn't about survival. The whole spread comes down to how the market prices those AI returns. What actually moves that revenue line? In the base case, Azure holds in the high 30s and Copilot compounds for about 15% growth. The bull case, capacity unlocks and usage-based pricing lifts revenue per user. The bear case, AI demand cools, optimization returns, and growth slips toward 10%. The bull case, straight up. 4 things go right. AI cash flow inflects as spending peaks. Azure stays elite. Copilot grows from 20 million seats to more than 50 million, and the multiple normalizes back toward 30 times. Get those, and the stock re-rates to a $660 target, roughly 69% upside from here. Now the bear case, with equal weight. Spending outruns returns. Depreciation permanently dents margins. AI demand disappoints, and the multiple just stays low. In that world, Microsoft grinds sideways on lower earnings, and the target drifts to around $430. Modest upside, and a slow path getting there. Both cases are serious. What's the chart saying? Honestly, not friendly yet. Microsoft is down 21% over the year and sitting below its key moving averages, but it's basing above $375 support and well off its $349 low, with sellers thinning. The read: a setup for patient accumulation, not for chasing a breakout that hasn't happened. So, who is this for? Long-term compounder owners, quality investors comfortable paying a fair price for a wide moat, and options sellers happy to buy blue chips at a discount. Who should skip it? Income seekers, the dividend is under 1%. Deep value hunters, short-term momentum traders, and anyone who doubts AI will pay off. Mark your calendar. The big one is July 29th, fourth quarter earnings, where Azure growth and margins get tested. Then Copilot's overhaul this fall, first quarter results in late October for the first read on next year's spending, and the ongoing OpenAI restructuring in the background. Now the trade, implied volatility, the market's expected swing, ramps into earnings so we sell into it. The primary play is a cash-secured put, where you get paid to promise to buy at a lower price. Sell the August $375 put. If assigned, you own Microsoft near $366, a steep discount. Options carry real risk, so size it small. 3 prices, 3 methods side by side. The floor, $430, the bear anchor, where risk and reward start tilting in your favor. The base, $540, a blend of the cash flow model, peers, and street estimates. And the bull, $660, if that AI cash flow inflection lands. Today, remember, you pay just $390. The scorecards: long-term, bullish; mid-term, constructive; short-term, cautious. The downtrend is real. Fundamentals earn a 9 out of 10, technicals just a 5. The one trade that captures it all: sell that August $375 cash secured put into the earnings ramp, then pair it with a January 2028 call option added on the dips. Final verdict: Microsoft is undervalued, medium confidence, a $540 fair value, a $543 expected value, about 39% upside, with the next catalyst on July 29th. Now, the fine print: this is research and education only, not personalized advice. Figures are current as of early July and will move, so verify live data, respect that options carry real risk, and speak to a professional before acting. Here's what we do differently. No hype thumbnails, no flip-flopping calls, no panic when the price wobbles. The same fact-based process every time, and we tell you the confidence level instead of faking certainty. If that's useful, subscribe, like, and share. This is a subscriber-led channel, and the tickers you request genuinely get made into videos when enough of you ask.
This video is for entertainment only, reflects the creator's opinions, may include stocks they own, and is not financial advice.